But before I go to the budget, it is important that we must make a note in respect of some of the major developments which have taken place. And one such major development is the demonetization. A lot of things which have taken place, which have been said about demonetization. And I think most of you would know that I am one of the ardent supporters of demonetization. A very strong words were said that what is it that we have not been able to detect a single amount of black money in this entire process of demonetization. If you had carefully heard the speech of the Honorable Finance Minister, I think immediately in the second paragraph of his speech, when he started with the tax proposal, he came up with extremely interesting statistics, which I want to put across to you. He said that there are about more than 1 crore accounts, bank accounts, where the deposits between 2 lakhs to 80 lakhs were deposited, with an average deposit of more than 5 lakhs of rupees. So 5 lakh crores have come into those bank accounts where the deposits are more than 2 lakhs and averaging to 5 lakh crores. So 5 lakh crores, I can guarantee you that all of us are living in India. We all live in the same way. Amount of 5 lakh in cash in your hands, generally in 60, 70 or 80% of the cases would not necessarily be, and they are all going to be subjected to investigation. More important statistics. More than 1,50,000 bank accounts had deposits of more than 80 lakhs in that bank account, with an average of around 3.5 crores, which is another 5 lakh crores. Out of 17 lakh crores deposited, almost 10 lakh crore, I'm not sure what is the amount deposited, but it could be somewhere in the region of 16 to 17 lakhs. 10 lakh crores amount, or almost about 8 or 9 lakh crores are under a suspicious category. Isn't this a success? Isn't this a great success of demonetization? I think it is certainly. I'm sure that people are going to explain away, but what is the quantum of the explanation that they are going to give? 80 lakhs remaining cash in your hands. 5 lakh crore people are saying 5 lakh bank account in 5 lakh crore. More than 80 lakhs with individuals. I think it is an interesting thing which we need to see. And therefore, the entire verification process which is going to take place post this is going to result into a very, very important aspect. Second very important aspect of this budget. I think I was having a lot of fear about what is the quality of the budget which is going to come. Are they going to deviate from their path which they had already taken? Are they going to become populist? Are they going to start giving doles? The reason is because there were naysayers all across that demonetization has given a significant amount of negative publicity to this government. It has become less popular. There is a UP election which was coming up, which is very important. Punjab, they were in any case doing bad. Are they changing their path and probably becoming a little more populist to see and ensure that they dole out things? I think one of the great things, and I would consider it to be a great achievement of this government, is that they have not deviated from their path and they have continued to remain on their path that they had accepted. You may have an agreement or a disagreement about the path which is being taken, which is right or wrong. I'm not commenting on that. But the question is that they did not deviate. They did not blink. They continued to take the path which they had taken, and that is what is important. I think it is the boldness and the firmness of policy which is important, which we need to see, and which is what is going to probably yield results over a long period of time. Otherwise, you may have a deviation which might take place 3 years down the line or 2 years down the line, and then whatever that you have achieved, you will again go back to the same levels. I think therefore the budget is required to be seen from these angles for the purpose of enabling us to what is there in store in future. They are not deviating from the fact that they are being continuously accused that you are continuing with the same policy which the earlier government had kept. No worries about it. I think what is important is the focus is on better implementation. Focus is on in respect of ensuring that the dividends in respect of the policy implementation are achieved. Very interesting aspect. Let's see how and therefore the success or the failure of the scheme for the purpose of disclosure, which is what they call it is Pradhan Mantri Garib Kalyan Yojana, specifically aimed in respect of deposit of money which is done in this bank account, which is these 10 lakh crores which is deposited. That is what is going to be aimed, and what is the success that we get is going to be decided on the basis of these aspects. The topic is going to be divided into three parts. One is on the economy. I'll just give you a very brief outline about what is the economic outlook, where do we see how we are going, and then I will quickly move to the direct tax provisions, and then my colleague Chirag would take you to the indirect tax provisions. Very less amendments on indirect tax provisions, but also he will touch upon the provisions with respect to GST, what is required to be done, and how can probably KC Mehta and company support you in respect of this part. On the economic, the economy is projected to be growing at around 7.1% in 2016-17, which is at the constant rate of 11 and 12 prices. Actual for the first half year is 7.2% because of the demonetization and otherwise slowing of economy. The growth on an average would become 7.1% in this whole year, which is no less. It is significantly good growth. The key areas of growth being pickup in agricultural growth, which had become stagnated for a number of years. Now it is picking up. The agricultural growth is showing a good sign of growth. This is also supported by way of a continuously good monsoons which are happening over a period of time. The modernization of industrial and government service sector. These are the three major factors as per the Reserve Bank of India are driving the growth in respect of 7.1% that we have been able to achieve. The IMF forecast of GDP growth of 7.2% and 7.7% in 2017 and 18 respectively, which is also a very robust growth, and we should be very proud to say that we would be one of the fastest growing economy in this range which we are talking about. The figures of fiscal deficit is very encouraging. It is only 3.5%. And if you look at it, the figure, and if you divide this figure of fiscal deficit of 3.5%, and this almost the entire fiscal deficit is only on account of the interest payment, which is very important to be seen. There is only 54,000 crores of primary deficit. Primary deficit is fiscal deposit as reduced by the interest payments. So if you look at it, we are almost coming, if you ignore the interest, and of this interest, significant amount of interest is paid to we have more of the domestic debt than probably external debt. So most of the interest goes to the domestic borrowings which are made. If you exclude that, we are only 54,000 crores of the 54,000 crores of primary deficit which is happening. So we are almost balanced our budget. And if you look at the next year projections, in case of the budget estimates for 17-18, it is going to be only 24,000 crores. And when I come to the figure in respect of the capital expenditure which is being made, you would see that the capital expenditure is the primary reason why even this primary deficit is happening. So we are investing more, and I'll come to this figure, very interesting figures which are there in respect of the policy, the area in which this government is taking, and whether we should be happy about what is going to happen and what is there in the store in future or not. The FDI grew by 36% in the first half of 2016-17 over 15-16, despite 5% reduction in the global FDI inflows. So India is showing, and as you would have seen, most of the persons who were in China earlier are wanting to make investments and continue to have their leg in India on more and more basis. Foreign exchange reserves are in 2000, as on 20th January 2017, is 361 billion US dollars, which is almost equivalent to one full year of the imports that we have. It's an extremely steady and good position that we are in, and therefore the key indicators are fortunately very good, very well poised for India, and therefore we can be sure about the future of India becoming on the right path. Let's look at the growth of the expenditure. I'm sure that all of you would have who had attended the lectures or the sessions of budget in the past. I said that the very fundamental basis of the allocation of expenses which were done on the basis of plan expenditure versus non-plan expenditure is an incorrect way of looking at it. What is more important to be seen is the capital expenditure and the revenue expenditure. Because what is happening is that when the capital expenditure is said, you invest in the future, you don't get the yield today, you don't get the dividends today, but you get the dividend over a period of time. Whereas when you talk about the revenue expenditure, and therefore now the government has done away with the capital expenditure and done away with the plan and non-plan expenditure, which was what was going on for decades or together. Now they have gone to two aspects: capital expenditure and and revenue expenditure. And in that, they are making the expenditure on the schemes, which is the key schemes which are definitely assigned and non-scheme expenses. So one which is targeted expenses, and in that also they have divided into capital expenditure and the revenue expenditure. Even the amount which is given to the state government as a funding, the government funding which goes in the state government towards the capital expenditure is also stated and shown separately. If you therefore look at it, the amount of the capital expenditure which is increasing, the percentage of capital expenditure is increasing, and if you see the budget, and if you see earlier, probably the capital expenditure over about 10.2%, which has now grown over to about 14%. It is consistently remaining at around 14% for the last 3 years, which is a good part. I think it is also important to see that the revised estimate, it's a very important document. I think we probably don't look at it, the budget estimates and the revised budget estimates. Now, what happens at the middle of the year when the budget is presented, they need to reallocate the funds which they have. And when they reallocate the funds, they do a cost cutting at one places and they make the investments in other expenses. What is important is last year, in fact, if you had seen a couple of years ago, I had said that the budget deficit or the fiscal deficit was sought to be managed by way of cutting down on the capital expenditure. They were cutting down on the capital expenditure, and thereby, because capital expenditure is in their hands, just you switch off the funding in respect of capital projects, automatically the capital budget would go down. But in this year, it is important to see that the revised estimate, though they have continued to have 3.5% of the fiscal deficit, they have increased the capital expenditure budget in the revised estimate by 70,000 crores. It is important to see if they wanted to, if the primary deficit, if this 70,000 crores was not additionally spent on the capital expenditure by the government, the revenue, the primary deficit, which was only 54,000 crores, would have been on the positive side. But they did not mortgage the future, and they decided to invest more, and they reallocated more money. Savings is done in respect of the revenue expenditure, and more expense is done in respect of the capital expenditure. These are all important aspects that we need to look at, the way in which the government is going, the way in which we are progressing, and how the future is going to be in respect of that. So if you look at it, there is a continuous growth which is happening in respect of capex, and that is what is going to be useful over a period of time. The inflation has always been a matter of great concern, and if you look at it, the inflation rate now is well below 5%, almost all throughout the year. The CPI-based inflation declined from 6% in July 2016 to around 3.4% in December 2016, primarily led by way of an extremely good monsoon with the reduction in the prices of food. The wholesale price index is actually going into the negative. Let me tell you that wholesale price index is not important for us because it does not affect the ordinary person, right? It's more in respect of this. What is important to be seen is the earlier figures of the inflation that we used to see were all primarily based on the WPI base, the wholesale price index base. Now, actually, the wholesale price index is going into the negative, and it is about to 3.4% in December 16. It has gone up, and primarily on account of the impact on the increase in the oil prices which are happening. The wedge between the CPI and the wholesale price index is significantly narrowed, whereas the CPI is also coming down significantly. Earlier, it used to be wholesale price index remaining into X percentage, whereas the CPI-based inflation would be a significantly on a higher figure. Another important indicator which affects the extremely downtrodden in the society is the food inflation. You know, what we call it is the inflation in the prices of food products. The food baskets in India, if you look at it, that is also dipped to a 2-year low of 1.4% in December 2016. So if you look at it, these indicators are significantly good. However, I must also point out that when you see the scheme expenses which are incurred, there is one shortcoming that I see in respect of this government, and that there are several expenses which are predominantly aimed wherever there is a reduction in case of scheme expenses in the revised budget estimate. I see the expenses which are on the social factors, expenses which are in respect of the women empowerment, expenses in respect of rural expenses have gone down, whereas the expenses in respect of metro rail project, expenses in respect of urban renewal, these have gone up. I think this focus is required to be reoriented, and more money, and you have to ensure that once you have planned for making an expense in respect of the rural areas, in respect of the needy sections of the society, it must continue to spend, otherwise the focus of the society can go down and the imbalance can be created. I think it is important that in the entire period starting from February or August 2014, if you see, the inflation in all the three levels have gone and remained between the two levels of 2% to 6% of the accepted levels of inflation fixed by the Reserve Bank of India all throughout. It has remained into this aspect. If you see, the red line is the CPI, then green line is the wholesale price index, which was significantly negative. If you see, the middle line is the zero line. And if you look at the CPI of the core goods in respect of that core CPI, that has remained significantly stable at the middle of what the accepted range of the Reserve Bank of India. So these factors are significantly in favor of what we talk about, and therefore the things are under significant control. Before I move to the direct tax, I wish to mention one thing. And let me go back for a moment for the demonetization. I think there is the success or the failure of demonetization would depend on the urban population. It is not going to be decided predominantly by the rural population. And the way in which we can support, and it is going to be supported and it is going to be beneficial to us if we move towards the non-cash transactions as much as possible. You will see that in budget, there are several measures which are taken for the purpose of enabling the non-cash transactions. However, it is important that we need to train ourselves in respect of usage of less and less cash. Look at the factor that from 17 lakh crore cash which was available in the market, they have reduced the cash portion to only about 10 lakh crores today. 7 lakh crore deficit there in the cash which is available in the circulation. It is only because, and we are in urban areas, most of the persons are capable of doing transactions, most of the persons are capable of receiving money by way of a non-cash basis. If we do that more, the requirement for cash in the urban areas would be significantly less, and if it is reducing, the more cash can be transferred to the rural areas, and in that situation, the difficulties which are going to be faced. And let me tell you that more number of non-cash transactions is going to benefit all of us together. I don't have to tell to the educated people like here that non-cash transactions is going to give a tremendous benefit to all of us. And please don't believe those naysayers that the non-cash transactions are costlier. It is not. It is, in long term, it is cheaper and much easier to do. So please, that's my appeal to you on behalf of KC Mehta and Company to my entire group of clients and the friends who are here, that please do that and support this activity. It is going to be very, very beneficial to all of us together. And I'm not saying it from a nationalist perspective. I always say that I am a selfish man, and I am telling from my selfish perspective. And selfish perspective means that I want you also to think from a selfish perspective. It's more important that we need to move in respect of getting the non-cash transactions. Let me first move to the business tax in case of direct tax. The changes which are made in the business tax area. And in business tax, I would first go to the corporate tax area. So in case of corporate tax, as you are all aware, that the government made an announcement that over a period of 3 to 4 years, they would reduce the headline rate from 30% to 25%. And we all expected, and rightly so, we expected that there would be a gradual reduction which would take place from 30% to 29% to 28%, and thereafter to 25%, which was an acceptable rate. In fact, this time there was a tremendous pressure, and we all thought that there is a tremendous pressure because the world is entering into a headline tax rate race, with Donald Trump announcing that he is going to bring down the tax rates in US from about 34, 35, 37% to less than 20%, or probably even around 20%. I think there was a need for the purpose of coming into that race, and therefore thought was that Indian government would also reduce the corporate tax rate significantly, or at least the surcharges would have gone. I think there is a slightly different approach which the government is, and I want you to ponder on that. What is happening is last year, if you see, that they introduced a new tax rate of 25% without any exemption in respect of new manufacturing companies. And they introduced a rate of 29% in respect of small entities for the purpose of the corporate tax rate. This year, what they have done is, they have introduced another category into this. So we have now a new manufacturing company not claiming any exemption. They would have a rate of tax of 25% applicable to them. We have got another category, which is all companies having turnover of less than turnover or total receipts of less than rupees 50 crores in financial year 15-16. They would have only 25% rate of tax. And there are no negativity in this, saying that you cannot claim exemption is not a requirement, which is there in case of a manufacturing company in the earlier period. So now you have got a huge bulk of companies which are being moved to 25%. We wish that probably in the next year or the year after that, the whole rate of tax would move to 25% rate. I think this is a good move. There's another way of looking at it. And you can look at it from this angle that yes, it is possibly we have missed an opportunity of probably remaining little ahead in the race to the lowest rate of tax. But be as it may, we are probably focusing where it is most required in India in respect of SME sector. So that's no other conditions which are attached. Your total income, absolutely simple rate. I think simplicity of the tax legislation is an important hallmark of this government also. They have said very clearly less than 10. In fact, it can probably have a severe-like aspect that a manufacturing company less than 50 crores would be very different than a consulting company having less than 50 crores of turnover. But be as it may, it would still be considered to be less than 50 crores of turnover. And it is fortunately, knowing Indian and knowing all of us very well, they have said that 15-16 turnover of this. If they had said 16-17 turnover of this, I think people would have managed to ensure that their turnover in the current year is less than 50 crores of rupees. So just to ensure that one which is over, one for which you have already filed the return of income, they have put 50 crores in that year so that you have nothing more to say. But most of the companies would be falling, large number of companies, and as you would have seen the statistics, almost a significant amount of companies would fall under this category. There is an incentive which is given to the startups. As you know that most of the startups incur a significant amount of loss during the initial period of time. It is impossible for them to make it profitable and wipe off their entire losses in a short period of 5 years within which the benefit was available. To ensure that the benefit is taken fully, they have said that they are entitled to get benefit of 100% tax-free deduction for a period of 3 years out of first 7 years from incorporation. This is a very important amendment which has been made. So in case, even if you incur a loss and you are unable to wipe off your losses from profits for the first 4 years, no problem, you can still claim the deduction in the 5th, 6th, and 7th year. So it's an important amendment which has been made. However, no change in the procedure which has been made. Possibly there is something which is required to be done in that also. We yet not have the entire ecosystem which support the startups. But I understand that in case if some further steps are taken in this aspect, you will also have some sort of a deduction which can happen and the benefit which would come in respect of the real startup in respect of this. Second change which has happened is that most of the startups go on getting more and more equity into their company. And in many times what happens that where more and more company, where round 1, round 2, round 3 financing come, the original shareholding of the original shareholder go below 50%. Though they have not transferred any shares, in such a time, what happens that whatever were the carried forward losses of these companies were concerned, they were getting not allowed to be carried forward because in India, we have provisions of Section 79 which say that in case if there is a change in shareholding as compared to the year in which you have incurred the loss and the year in which you are claiming set off beyond 51%, in that case, the entire carry forward loss would not be allowed to be carried forward. To ensure that the startups do not lose merely because they get successive rounds of funding, they have provided so long as the original shareholders continue to hold shares in the company, even if where their shareholding go below 51%, the benefit of carry forward would not be taken away so long for losses incurred in the first 7 years. It's a very important provision which has been made. Serious drafting error in respect of that, and I must proudly say that we have written to the board already. Board has accepted that the way in which the amendment has been carried out is not correct, and they have agreed to rectify that aspect. And that is what is another aspect which is going to happen, Section 79. But the primary focus is going to be that even where the startups go, their income go below 51%, in such a situation, they will not be denied the benefit of carry forward losses. There are no thresholds. As of the present law is slightly skewed. We will have to wait for the final law to come. They have accepted this position, and therefore I'm not commenting on the deficiencies which are there in these provisions. The carbon credits, there was a dispute whether carbon credits are capital receipts. The sale of carbon credit would be considered to be a capital receipt or a business income. That issue has not yet been addressed, but to ensure that there is an encouragement which is given for concessional rate of tax on sale of carbon credits, they have provided for a flat rate of 10% in respect of carbon credits. However, KCM takes a view that sale of carbon credit would be considered to be a capital receipt and therefore not chargeable to tax at all. The present way in which the provisions have been introduced does not take away the right to claim that a carbon credit is a capital receipt, and therefore it may be possible to say that so long as you are able to say that a sale of carbon credit is a capital receipt, you will still not be liable to pay even 10% tax. In case if the department is successfully be able to say that a carbon credit is chargeable to tax, then there would be only 10% tax chargeable on sale of the carbon credits. There was always a dispute in respect of the chargeability of interest on the non-performing assets, and there were provisions in respect of scheduled banks that non-performing assets, interest on non-performing assets would be chargeable to tax only on the actual receipts or the realization of that money. Now that benefit has also rightfully extended to the cooperative banks. There was a provision which prohibited which charged to tax. There was a donee-based tax on the gifts which are received. These provisions were divided into two parts. In case where the gifts were received from the individuals' HUFs, then all the items of gift, which would include the immobile property, which would include jewelry, which would include cash, which would include also the bullion and many other shares, etc., every other assets would get included in this. However, in case where the gifts were received by a partnership firm or by a private limited company, in such a situation, the gifts were not chargeable to tax except where the gifts were in the form of equity shares or in the form of shares. They have expanded the scope of donee-based gift, and they have said that gift received by even a partnership firm or a private limited company or an AOP or a body of individual, all such persons would be covered by the donee-based gifts, and therefore all such gifts would be chargeable to tax at the applicable rate of the slab which is applicable to such persons. So in case this would significantly affect the companies and the firms and the AOPs and the BOIs, that is the trust, etc., which would be receiving the gifts. The same exceptions which were there earlier in respect of gifts received by the relatives at the time of on the death of a donor or at the time of the marriage of the recipient, etc., these have continued to remain in force. But rest of the provisions now, the additional entities have been included for the purpose of taxing on the donee-based gifts. There was a dispute in respect of the real estate players. In case of real estate players, they have a stock of the completed premises which are available, which are not sold. There was an impending danger. The present law does not say that these, say for example, I have a residential house which is available, which is ready and completed, and I still do not give it on rent. There is a deemed rental which could have been charged in respect of the real estate player, and we know that there is a lot of inventory which is available to the real estate players, and on that entire unsold stock, there would be income from house property which could have been charged, which is being charged, which in fact, but at present, most of the assessing officers do not charge it. There are some sections where it was charged. A big focus has been now introduced saying that in such a case, they would be charged tax, but an exemption is given for the period of 1 year from the date of completion of that. So they will have to liquidate their stock within a period of 1 year. Otherwise, the interest of the deemed rental in respect of that would be chargeable to tax. So it's a major thing which is going to happen, which is going to compel the real estate players in respect of the liquidation of their inventory immediately after the completion certificate is obtained. In case if the completion certificate is not obtained, in such a situation, the provisions would not still kick in. Just to give as a fillip to the non-cash transactions, earlier we had the provisions stating that in case if the cash expenses incurred in excess of rupees or any expenses which are incurred in excess of rupees 20,000 would not be allowed as a deduction unless it was incurred by way of a crossed account pay check or a crossed bank draft or account pay bank drafts. They have said that now that limit of 20,000 has been reduced to 10,000. A very good step. Earlier, originally it used to be 2,500 rupees. Because of inflation, they had raised it to 20,000 rupees. Now they have brought back to 10,000 rupees. Now they have said that any expenses which is incurred by an entity, they will not be able to get the deduction of that money unless it is paid by way of a crossed account pay check, cross draft, or by way of an electronic systems of payment like many other methods which are available in respect of that. The earlier the deductions or the prohibition of making the cash payment was only applicable where there was a revenue expenditure which was incurred. In case if you purchase say for example, if you purchase if you incur a capital expenditure, in that situation, this restriction of 20,000 rupees of cash was also not applicable. Now they have said that the limit would be 10,000 and it would also be applicable to the capital expenditure which is incurred by a person. So now if you purchase an asset by making payment in cash, the amount which is incurred in cash in excess of rupees 10,000 would not be considered as a part of the cost of acquisition, and therefore the depreciation to you would be available only on the reduced amount. So that's a very important change which has been made, and similar amendment has been made in respect of 35 AD, which deals with respect to the preliminary or preliminary expenses. Electronic clearance system has been also allowed as the allowable method for the purpose of making a deduction. As you are aware, Section 43B says that in case where there are certain expenses which are incurred would not be allowed as a deduction unless they are actually paid either on or before the end of the year or on or before the due date of filing the return of income. In that, there are several lists in which interest to the nationalized banks or the scheduled banks were also covered. Now they have also included that any interest which is paid to a cooperative bank also would be covered. So in case if the interest is not paid to the cooperative bank, in that situation, that interest would not be allowed to the deduction to the person who was liable to make such payment, and it would be allowed to the deduction only in the year of its actual payment. A very good scheme which has been introduced, which is what we call it as a profit-linked deduction in respect of affordable housing. As you are all aware that government has given very tall promises in making available the affordable houses to a very large section of society. The figure of around 2 crores was floating around. And to ensure that people do bite the bullet in respect of that, a scheme was introduced for the purpose of giving completely tax-free profits of the scheme which are introduced. In this scheme, the eligible affordable houses were 30 square meter, equivalent to around 330 square feet, in the metros or 25 kilometers across from the municipal limits of such metros, 4 metros. And in other cases, it was 60 square meters of the built-up area, which was around 660 or about 700 square feet of this area. If such type of houses are concerned, the entire profits from that would be available as a deduction, provided the completion certificate is obtained within the period of 3 years from the date of commencement. Now that period of 3 years have been extended to 5 years, considering the sluggishness which is happening in this real estate trade. Second, a major change which has been made is that they have said that now, instead of built-up area of 30 square meter and 60 square meter, it would be carpet area of, which probably almost in most of the cases would have an increase of around 20 to 30% in the size. So now 300 square meter or 30 square meter of a carpet area would almost mean like about 360 or 400 square meter of the, it is 36 to about 40 square meter of the built-up area, which gives, and in case of an area like Baroda, we would have 60 square meter of the carpet area, which would be almost equal to around 700 or 750 about 800 square feet of house, which gives a reasonably good house for the purpose of considered as an affordable housing project. So, very good amendment, and I think looking at probably what we have been always thinking, that the real market today, in case of affordable housing, is the real market. We have been telling that for some time. I think all those persons who are in affordable housing are able to sell, because there are so many schemes which are available for the purpose of funding the affordable housing projects. There is a government subsidy available, there is an interest subvention which is available, and there are facilities in the form of the tax-free benefits are also available in respect of affordable housing. And therefore, we envisage a large chunk of investments happening in the affordable housing. But as we say that in affordable housing, the real thing happens before you start digging your plinth. The real thing happens at the time of planning of these premises, rather than possibly doing in better construction. I think the better planning is going to result into better cost and better economies which would be available, including the cost of holding such premises by the persons who acquire these premises. A technical amendment has been made in section 10AA, which deals with the SEZ deductions. I would not go into this, that it is to be allowed on the total income after whatever are the set-off of losses which are made. This is only for the purpose of negating a decision which was rendered in respect of that. In respect of bad and doubtful debts to the bank, there was a provision that up to a 7.5% of the total net worth would be allowed as a deduction, up to a ceiling. That has been raised to 8.5%, which would enable the banks to create more provisions without paying tax in respect of these amounts. There was a dispute in respect of the credit or the manner in which the disputed tax credits would be given in case of foreign tax credits. Now, what is happening is, let's say, for example, if I am executing a project outside India, and there is a dispute which is there with that government as to what is the actual quantum of tax which is payable by me, and the government has made an additional demand of tax. If I am disputing it, in that situation, when I file my return of income for the current year in India, it may not be possible for me to claim the credit for the disputed tax. When the disputed gets settled 5 years down the line or 2 years down the line, in such a situation, at that point in time, my returns would have become barred and I may not be able to claim the credit. They have made a provision in section 155 stating that when the dispute gets settled and when an additional tax is paid, I would be entitled to claim credit of the tax which is so paid subsequently in the year in which the original income was offered to tax in India. So an assessment year 17-18 tax is paid, say for example, in 2020. Then in 2020, I can file an application, make the credit or claim the credit of foreign tax in assessment year 17-18 where the income was offered to tax. So a good provision may not affect many, but this is something which is in the right direction. There are 2-3 very important changes which have been made with deals with the international tax. India has never been as part of the thin capitalization, meaning that in case where there are investments which happen, generally 80% of the structuring which would happen when the foreign investments would take place in India, 80% of the investment would be generally hit by the thin capitalization. Because what happens that in case the investments are made by way of a loan to Indian entity rather than as an equity, when there is a surplus which is generated in the Indian entity, it can be repaid by way of a repayment of loan. But in case if the original investment had come by way of an equity, then that money would have gone by way of a dividend distribution. And when it goes by way of a dividend distribution, the problem that happens is that it would be subjected to dividend distribution tax, and also it would be chargeable to tax in the country from where the investments have come. So there was a significant amount of additional tax in case if the amount was. So generally people would say that a very nominal amount would be kept as the equity, and a significant portion of investments from foreign country or even investment from India, etc., would come by way of what we call it as the debt. To ensure that this does not happen, India has suddenly moved to the thin capitalization. And internationally also it is accepted that you cannot use these type of practices for the purpose of saving the tax. And therefore they have generally a thin capitalization as a rule. India has now ushered into a thin capitalization rule, and they have put a simple principle that in case of your interest payment to an associate enterprise, which has to be one of them, has to be a non-resident, if it is more than 30% of your EBITDA, which is earning before interest, tax, depreciation, and amortization, in case if it is more than 30%, that more than 30% is to be ignored. It is to be carried forward and to be allowed in the subsequent period, so long as that subsequent period happens to be within the period of 8 years. But in each year, you have to satisfy this requirement of 30% of EBITDA. So if your EBITDA is $1 million and your tax payment is, say, for example, interest payment is 70 million, in that situation, out of 70 million, only 30 million would be allowed, 40 million would be allowed to be, 40 million will be allowed to be carried, 400,000 would be carried forward to the subsequent period and would be allowed in the subsequent period. So you don't lose that benefit, but you will still be able to, not be able to claim beyond that. So you can't erode your base. This is also part of the item number 4 of the base erosion and BEPS practice of OECD, wherein they have said that you cannot use this practice for the purpose of eroding base by structuring your capital in this manner. However, I must tell you that most of the countries which have followed the thin capitalization route have got two twin tests. It is not purely on the basis of a percentage of EBITDA. It is always with reference to the debt equity ratio that you have. Now, some countries have got fixed debt equity ratio that in case if your debt is more than, say, for example, 2:1 debt, or if your debt is more than 3:1 debt, in that situation, excess debt, only in such type of cases, this thin capitalization of 30% of EBITDA, etc., would come into picture. Similarly, some countries have followed that if on an overall group basis, if your EBITDA, if your debt equity is, say, for example, 1.5, in that case, if your Indian entity has more than 1.5 debt equity, in that situation, only the excess would be ignored. That's the principle that most of the countries have followed. India somehow or the other has not followed the twin principles. It has got the simple principle of 30% of debt equity, 30% of the EBITDA, even where your debt equity is significantly lower and absolutely comparable with respect to the world trends. So I think that's what is not applied here. But apart from that, similarly, there is a threshold of 1 crore. A small assessee would not be affected. Any company which is paying interest of less than 1 crore of rupees to an associated enterprises would be out of these provisions. Similarly, for banks and insurance companies, this is not covered by the provisions of the thin capitalization rules, which is the interest restriction which has been provided for. There is a minimum alternate tax. There are some changes which are made in minimum alternate tax. I must very proudly mention that KCM has always been in the forefront in respect of policy making in the government. This one change which has happened in respect of companies which have migrated to Ind AS. Now, a large number of companies are probably presently migrating into Ind AS, and there are quite a large number of companies which would migrate into Ind AS in the subsequent years. So, in such a situation, where they converge into that, their profit and loss account is prepared on a different basis than the basis in which the normal accounts are prepared. And on convergence, there are significant amount of assets and liabilities will have to be restated, and the restated amount will go into what we call it as other comprehensive income. Now, there was a lot of doubts which were expressed in respect of how this would be treated so far as the minimum alternate tax is concerned. Because a company which is not following Ind AS would prepare its accounts and its profits would be X, whereas a company which prepares accounts on the basis of Ind AS, it would be on Y, because in many cases in Ind AS, there is a fair value as a concept for the purpose of recognizing a transaction. So the profit would be valued on a different basis. How do you compare and how can you levy tax on the different basis? So a committee was set up. I was a member of that committee, and the committee presented its report and gave its finding. I'm very proud to say that verbatim, every word of that committee has been accepted, and this entire amendment which has been brought is exactly as what was suggested by that committee. So I think, and this has taken up some very important aspect, and I'll just briefly tell you, it's a very technical amendment, and I will briefly tell you what happens. In case of a Ind AS company, the profit and loss is divided into two parts. One is net profit, which is calculated on a basis, and there is the second part which we call it as other comprehensive income, which predominantly deals with the adjustments on account of fair value assessments. So, for example, if you have a retirement benefit plan, and retirement benefit plan, there is an actuarial valuation, and if there is a difference in the actuarial valuation, and there is a gain or a loss which happens, it goes into other comprehensive income. If you have got a financial instrument, which probably because of the fair value assessment, it gets revalued, in such a situation, those would go into other comprehensive income, which is not required to be done in case of a non-Ind AS company. Now, therefore, what this says that your starting point would be net profit, which is almost similar to what you would have in case of a non-Ind AS company. And in case of other comprehensive income, the amount which goes to other comprehensive income, either by way of a debit or a credit, it will be adjusted to the book profits only if these are the items which never come to P&L in future. But those items which are going to come to the P&L in subsequent period, either on account of disposal of an asset or on account of the reclassification later on, in such a situation, those items would be not added to the P&L account on the basis of this. This gives a significant amount of relief to most of the persons who are migrating to Ind AS. Similarly, on the date of convergence, on the transition to this, whatever amount which is adjusted to other comprehensive income, in case if this does not get migrated to P&L in future, entire that amount, other than those amounts which are pertaining to revaluation, a time period of 5 years would be given for the purpose of making payment of tax by adding 1/5 of that amount to the book profits every year. So this is primarily the aspect. Second, which is important aspect which the committee has stated and which has been accepted by the government by way of introducing and mentioning that in the provisions relating to the on the memorandum explaining the provisions of finance bill, that there is a implicit relationship between the distributable profits and there is and the amount of minimum alternate tax which is charged. So therefore, if there is a change in the Companies Act which prohibits declaration of dividend from certain unrealized gains, automatically it would get reflected in the amendment to the MAT. And that is what is something which is very important in respect of that. There is a technical amendment in respect of non-cash. In fact, in case of a demerger, which happens in case of a company which is following Ind AS, there is a deemed realization of gains on account of fair value of assessment which is transferred. Now, if this gets credited to the P&L account, there was a likelihood, so that has been provided that in such type of cases, the capital, the amount which is credited to P&L account will be ignored for the purpose of calculation of minimum alternate tax. I may answer this question in case if someone has got some specific question on that. The carry forward and set off has been increased. The period for set off of the carry forward of a minimum alternate tax has been increased to 15 years from an existing 10 years. The primary purpose of doing is that when you are going to reduce the rate of tax from 30% to 25%, in such a situation, the ability to recoup the losses or ability to utilize this credit is always going to be more because the difference between the tax as per the normal provisions and the MAT is less, and therefore more time is given for the purpose of ensuring. In case of the MAT credit, in case of foreign credit, a very technical amendment has been made. In case if you have any questions, I would be very pleased to answer that. But this amendment has been made to ensure that there is no double advantage which a person takes in respect of minimum alternate tax and also the foreign tax credits. Similar changes are made also in case of alternate minimum tax, which is applicable to the firms and the LLPs who are claiming deductions under Chapter 6A or 10A, etc. So these are amendments which are made in respect of that. They are generally good amendments which are made. In case of the international tax on capital gains, an amendment which has been made in respect of indirect tax provisions and primary amendment of that indirect tax, as you are aware, pursuant to Vodafone decision, which all of you are all aware that Vodafone was getting away with respect to not paying any tax anywhere in the world, and that's the reason why an amendment was made to Section 9. Just to take that amendment forward, it was also likely, and the amendment which was made, that in case if a transfer of a foreign company's shares take place and these shares derive its significant value from the assets which are situated in India, in that case, the capital gain on those shares would be liable to pay tax in India. This has resulted into a significant tax which would have payable by foreign institutional investors who would have their schemes which are predominantly aimed at making investments in India. So to allay those fears, they have said that no tax would be levied in respect of FIIs which have made investments in India and or the persons who are liquidating their investments into these FIIs. So it's a good amendment which has been made. This is only to allay the fear in respect of these persons. In case of closely held companies held by non-resident, which was 10%, an amendment which was made, it has only been, the same amendment has been continued, but it has now been given a retrospective amendment which is beneficial to the SSE. There is one thing which I must mention. This government did mention that, that they are not going to make any retrospective amendment. I don't think so that is true. There are some amendments which have been made on both sides which are retrospective. But these are, I would say that these are more clarificatory amendments. Earlier also it used to be only clarificatory amendments, though they were substantive. Today also there are amendments which are made, but a significant portion of these amendments are in favor of the SSC, and that's the reason why people are not objecting to it so much. But still there are some retrospective amendments. We have very popular masala bonds, which are Indian denominated bonds which are held by the non-residents. There is a tax exemption which has been provided to the non-residents. When there is a transfer between two non-residents, it would not be chargeable to tax. And even in case where the gain on account of rupee account on the subsequent purchaser of the bond would also not be chargeable to tax in their heads. A good amendment which has been made. A very interesting provision which has been made in respect of the secondary adjustments in case of transfer pricing. As you are all aware, in respect of international transactions, there are transfer pricing provisions. And in case of transfer pricing provisions, there are three ways in which the adjustments can be made. One is an accepted adjustment, wherein you yourself make it. Second is by way of an order by the government, either under alternative mechanisms, and you accept those orders. Or the third one is where you litigate and you lose the benefit because the assessing officer does not accept the stand which you have taken. So these are the three alternative ways. They have said in case of first two methods, wherein it is an accepted adjustment, either on your own or in case where the government makes an adjustment, you accept it, or you have gone for an advanced pricing mechanism and you have accepted it, or there is a mutual agreement process wherein an adjustment has been accepted. Now, what used to happen? And let me give you a brief background about what used to happen. It used to happen that, say, for example, I am a wholly owned subsidiary of a foreign company. Now, if I, say, for example, make a royalty payment of $10 million, that would go, I would pay whatever 10% tax in India, and the money would go to the foreign company. If an adjustment is made by the government, what would happen that I, say, for example, 10 million, instead of 10 million, 6 million is considered to be an arm's length, 4 million adjustment is made. But still 4 million has gone to the foreign, my holding company. I still pay only 30% tax on that. There is no dividend distribution tax which is paid on that amount. And therefore, the money still goes to the foreign company without paying any dividend distribution tax. So this was a problem which was faced, and it was highlighted to the government several times. And people used to do, and this was a misuse which was done by the provisions, they will first determine the rate of 10 million for the royalty. They will go for an arrangement with the government. Government would fix it at 6 million. They will continue to pay 10 million. They will make adjustments of 4 million in the books, but 10 million would be paid. So 4 million would go without payment of dividend distribution tax. This was something which was happening. So they have introduced transfer pricing provisions, which is what they call it as the secondary adjustments. And there are two types of secondary adjustments which are made. One where there is an accepted adjustment which is made, wherein 10 million to 6 million, 4 million accepted, no litigation, nothing which happens. In such a situation, they said that you have to adjust your books of account and show that 4 million is receivable from that company. So you will have to ultimately, if you do not receive this money, you will have to pay dividend distribution tax also on that, or you will have to see that 4 million is advanced by you to that company, you will have to recover interest on it. So that's one aspect of it in case of an adjusted adjustments which are made. Very important amendment. Second, which they said that in case if it is not an accepted adjustment, there is a litigated adjustment, which they call it as a transfer pricing adjustment made by the assessing officer, though you are contending otherwise. In such a situation also, there is a secondary adjustment which have been provided for. We say that in case if there is an adjustment which is made, that amount is deemed to be receivable by you, and interest on an arm's length basis will have to be charged by you for recovering unless and until that money is repatriated by you. So that's also a secondary adjustment which is made, which is a globally accepted phenomenon. This is not something which is new. Unfortunately, India rose to that significantly later. And considering, honestly speaking, the amount of transfer pricing adjustments that we make, if this was done at the earlier stage, it would have been a harakiri. But fortunately, this is what has this has happened now. And therefore, in case if the transfer pricing adjustment which is made, not only that year it would be adjustment, but in subsequent periods also interest would be laid. This is applicable only in respect of adjustments which are made in assessment year 17-18 onwards. It does not apply to adjustments which are made for the earlier periods. We come to the other aspect is in case of domestic transfer pricing. This was something which was a matter. In fact, let me also mention that we were in the forefront in respect of ensuring to say that restrict this deduction only where there is a tax arbitrage between. There was a provision which was made that where there was a related party transactions in India in between the two resident entities, then also it was subjected to the domestic transfer pricing provisions, wherein a n number of documentation which was creating a lot of problem, which included salary paid to the managing director, salary paid to the directors, it included commission paid to the directors, it included purchase and sale between two entities. We said that you restrict it only where there is a differential rate of tax applicable between the two entities. Say one entity is taking a deduction under as a SEZ unit, one unit is situated, say for example, in a tax-free zone and therefore 100% tax-free. If there are transactions between that, you restrict only to determination, because otherwise one entity pays 30%, another entity pays 30%. Where is the question of tax arbitrage? Why there would be a deviation? Fortunately, they have now removed all transfer pricing provisions applicable to domestic transfer pricing. A very great relief which would happen. Of course, it affects our business in any case, but I don't think so that we are interested in doing any business which probably does not yield result either to the government or to our clients. But this has completely been taken away, and it would be restricted only to the transactions where the transaction is between one entity which is taking a tax-free tax concessions and other entity which is not. So where there is a tax differential, only in that situation it would apply. A technical amendment which has been made for the purpose of in section 90 and 90A, which deals with the double tax avoidance agreement, stating that a term which is not defined under the double tax avoidance agreement, and if it is defined in the Income Tax Act or under an explanation thereof is given under the Income Tax Act, that would apply. Now, what was happening is there was a technical thing like, say, for example, a concept like poem. Poem is not defined under the Income Tax Act. Poem is explained under the Income Tax Act. So the question was that whether for the purpose of interpretation of the double tax avoidance agreement, can I use this definition? Now, this was one of the aspects which was happening. Now they have amended to say that even if it is not defined under the Act, but explained under the Act by way of a notification or by way of a provision under the Act, those explanations would apply even in respect of that. This would be primarily applicable to poem. It would also be applicable to GAR type provisions, etc. These are the provisions which would be applicable in respect of these aspects. But we will have to, this is a very potent provisions, and as you see that some of the treaties that we have done, in the treaty itself there is a override which is provided under the Act, which says that in case if the arrangement is covered by way of an anti-evasion provision under the Act, like GAR, those provisions of the anti-evasion would prevail and the treaty would not, like, say, for example, we have similar provision in Singapore Treaty. Let me come to the aspect of the poem. Now, there is no change which has been made in respect of poem in the current year. So when the change is not made in poem, that is place of effective management, it is actually becoming effective, or it has already become effective for 11 months in the current year, because it is applicable from assessment year 17-18. This is predominantly applicable to outbound investments which are made by the Indian entities, and this would affect primarily that. So I have set up a company which is outside India. Whether that company's income would be chargeable to tax in India or not would be decided on the basis of the test as we can, in case if the place of effective management of that company is situated in India, then that company would be chargeable to tax in India. And earlier the provisions were fairly liberal. Now they have provided for the poem provisions in India, and that is what is applicable. There are final guidelines which have been given on 24th of January 2017. Earlier the draft had come, which is similar to the draft. Though it is not covered by the finance bill itself, it is something which is going to affect all those persons who have made outbound investments from India. I would briefly deal with those provisions as to how does that operate in India. The entire emphasis is on the substance over form. Not merely because it's a separate legal entity, merely because you are showing the records that it is being managed from outside India, it would not be considered to be outside India. And in case if it is not considered, if it is effectively managed in India, then entire income, global income of that company would become chargeable to tax in India. So it is very important to ensure that you satisfy the test of the place of effective management being outside India in respect of these companies. It is very, very essential for you to see that. Now, what is important? The definition which is contained in place of effective management under the Income Tax Act says that place of effective management is a place where key management and commercial decisions, it's not all decisions, the focus is on key management decisions. Earlier, the management and control was the concept. Control is not there. Even if the control is in India, so long as the management is outside India, in that situation, it would still be considered to be managed outside India. So the focus is on key management and commercial decisions. That's what is important. That are necessary for conduct of the business. So these are necessary for the purpose of overall conduct of the business. It is important that it's an overall conduct, not a significant or a functional part of it. It is not important. It's an executive level decisions which we are talking about, not the mid-level or the low-level decisions that we are talking about, of an entity as a whole. So what is important? Entity as a whole, not a functional decision. We are talking about functional, that's the top management decision, not the day-to-day operations, but the entity as a whole decisions are taken, and in substance taken. So not merely on record it is taken. Say for example, if I go to some place and hold a board meeting and take a decision, like say for example, there is a decision of expansion of $15 million which is to be taken, I go by the morning flight to Dubai, take the decision and come back by the evening flight. I don't think so that that's the decision which would be considered to be in substance taken in Dubai. I will have to go there, I will have to study, or possibly whichever is the location. There are places and there is a research which is required to be done, and enough time which is required to be given for the purpose of taking that final decision and come back. So I think in substance you will have to see that the decisions are actually taken outside or at a different location than in India. But if these are substantially taken in India, then the place of effective management would be situated in India. The guidelines predominantly deals with the dividing this foreign entity into two parts. One is the active entity and passive entities. Now, those active entities are the rules for the purpose of deciding the place of effective management in India is significantly diluted in respect of active entity. And active entities are those entities which have got some purpose of being outside India. And it is defined negatively that if it is not a passive entity, it is an active entity. And what is a passive entity has been stated is that where the passive income of such entity is equal to or more than 50% of the total income is considered to be a passive income. And any one of these things are, what we call it as that it has got a test of income, it has got a test of assets, and there is a test of employees. So these are the three tests which are. So more than 50% of passive income means interest, royalty, interest, royalty, fees for technical services, that capital gains, interest, and the rental income. If these are the type of income, if that constitutes more than 50%, it automatically becomes a passive company. If the assets, more than 50% of these assets are situated in India, then it is considered to be a passive company. More than 50% of employees in numbers are either resident of India or are situated in India, then also it becomes a passive company. And second, value test in respect of employee, that if 50% of the salary of the persons who are engaged by that company are paid to employees who are situated in India or resident of India, then also it would consider to be a passive company. So any one of these four conditions are satisfied, it would be classified as a passive company. And in that case, a far more detailed conditions would apply for the purpose of determination whether the place of effective management is situated outside India or not. But in case if you do not satisfy this condition, in such a situation, you are considered as an active company, and the only requirement is that the board meetings of such company should have taken place outside India, or majority of the board meetings should have taken place outside India. And these are the board meetings not of nominee board directors, these are meetings of the board which is entitled and authorized and competent to take such decisions. If you have nominee directors who are probably accountants or probably lawyers or probably a small level clerks who are situated outside India, if they take decision, hold board meetings all outside India, that would not be considered to be decisions taken in substance outside India. Because they do not have the brain power, they do not have the ostensible authority, they do not have the competence for the purpose of taking such decisions. So it is very important that the meeting should actually take place where the decisions are taking place, should have taken place outside India. Once that test is satisfied, so I think this would therefore require that you need to look at the board which you constitute, you need to empower those boards, and you need to ensure that these boards do take place outside, meetings take place outside India. In respect of passive income, there was a doubt that another aspect of that, in case if there is the entire income which is coming on account of the transaction of purchase as well as sale between the two related parties is, in that situation also it would be treated as a passive income. But in case if you are purchasing from a non-AE and selling it to an AE, or you are purchasing from an AE but selling it to a non-AE, these do not constitute AE transactions. So only interjected entities would be covered by that, otherwise it would not be, it would be outside that. the data for current year plus 2 years earlier to that is to be considered, not only current year. So you will have to see that the test is satisfied in the average of the 3 years data. And in case of new companies, the shorter period will have to be taken into consideration. In case of passive companies, there is the hierarchy of decision which is important. This triangle is required to be kept in mind. What is most important is the place where the top level decisions, top management decisions, top management states, top management takes decision, top management operates. That's the most significant portion of it. Middle level is less important. And the low level is, or the bottom level is absolutely unimportant. So for example, let's take a situation that you have actually a manufacturing operation which is going on, say for example in Kazakhstan, and in that only thing is that only workers and the supervisors are there, whereas all managers, all senior executives, all marketing people are in India, though despite the fact that you satisfy all the 4 tests, still in such a situation, what would happen that it would be considered to be a passive income, and in case if it is a passive, that poem would be considered to be situated in India because the entire middle and the top level is situated in India. So you need to be very careful about the way and the place and the manner in which the decisions are taken. So the top level would consider the board of directors and the top level management. The middle level would be considered to be the executive or the mid-level management, etc. And they do ensure that they take and oversee the overall operations of the company, whereas the day-to-day operations would be decided by the operating level management. So you need to, so this is what is important, which is to be taken into consideration. There are very detailed guidelines, there are detailed presentations, and in case if any one of you need support in respect of this aspect, we are available for the purpose of providing support in respect of advising as to whether that would feature into a place of effective management or not. I'm not going into greater detail because this is predominantly in respect of that. Another major amendment which is coming up is in respect of the general anti-avoidance rules, and that is GAR. Most of the countries have this. See, there is a concept of SAR and GAR. SAR is specific anti-avoidance rules, and GAR is general anti-avoidance rules. SAR applicable to only specified situations. Transfer pricing is one SAR, what we talk about. Place of effective management is another SAR. The aspects of, like we have those dividend stripping transactions that we talk about, these are specific SAR. That is the specific anti-avoidance regulations or rules. Whereas general where there are no other provisions, in case if the government feels, or in case where the bodies which are so appointed feels, that the primary objective of those transactions, or the structures, or the series of transactions, or the scheme that you have entered into, is to reduce the tax. In such a situation, they would ignore those transactions and consider as if this has not taken place at all, or they would modify, they would reclassify. The significant amount of things they have powers in respect of doing it. So therefore, it is essential to see that we do not fall within the GAR provisions whenever a planning is done. And this is not applicable only in respect of international transactions, it is applicable to even pure domestic transactions. The major test in respect of applicability of GAR is that the main object of that, there is no other commercial substance, the only or the main object is to save taxes, or to evade taxes, or to take or obtain the tax benefit. That is what is the most important aspect. The second is that rights and obligations are not at arm's length. So this would not have taken place had it been with a person who is not related to you. You are doing the transaction which is normally not done with the third parties or a person who is at an arm's length. There is certainly a misuse or an abuse of the provision of act. So though it is all within the provisions of law, but there is a misuse or there is an abuse of the provision of law. It lacks the commercial substance. So it does not have any other substance. Like, so for example, you would not be able to see any substance in that transaction except taking the tax advantage. And it is not for a bona fide purpose. So in case if any one of these four conditions are satisfied, plus its main object is to save taxes, in that situation, it can be considered to be an impermissible arrangement. And if it is considered to be an impermissible arrangement, in that case, they have a significant powers which are listed herein. That is, they can disregard this entire arrangement. They can completely disregard the arrangement. They will treat the entire arrangement as void. Now let's take a situation that I give a loan to X, who in turn gives loan to Y. Now if I had given loan from X to Y directly, if this was to fall as a dividend because of the X company and Y are related, in that situation, they would say that this is nothing but a GAR, because you are giving tax-free loan to this person is giving tax-free loan to another person. Had this loan been given directly, it would have become a dividend, and in case if it becomes dividend, they have an authority to ignore X completely and say that it is a direct loan to this man, and therefore it would be featuring as a dividend to this person. So these are all GAR provisions which are there. They have enormous power in respect of disregarding a series of transactions, and they say that what is the commercial substance of giving loan to X and then to Y? You could have easily given loan to X directly or to Y directly. And therefore, that is what it is. So they can completely disregard. All the accommodating parties, in this situation, X would be an accommodating party. He has allowed his books of accounts to transfer this money. So they can completely disregard the accommodating parties or treat the parties as the same parties. They can reallocate or recharacterize a transaction. A loan transaction can be considered to be an equity transaction. An equity transaction can be considered to be a loan transaction. There could be a transaction which is by way of a loan can be considered as a dividend transaction or dividend distribution. There could be a transaction in respect of a lease can be treated as a sale transaction. All these recharacterization is permissible in respect of a GAR provision. Reallocation of place of residence. Let's take a situation that there is an American company which makes an investment into Mauritius, and Mauritius company making an investment in India. In case if they see that there is no commercial substance for moving this investment from Mauritius, except taking the tax advantage of Indo-Mauritius Treaty, just giving you an illustration, they can say that, okay, I will not consider this Mauritius company as a resident of India. Mauritius, I will consider it to be a resident of US, and therefore levy the tax on that basis, because the actual investments have come from this company. So similarly, say for example, I have a company which is in US. I've got a branch which is in Dubai, and that is how I route this transaction. They said I ignore that this transaction is in Dubai. This transaction is possibly coming straight from US, etc. So this can happen in large number of e-transactions which are happening, wherein people artificially put their servers at a different location. They put some place in respect of where the billings are taking place from one country. You would have seen, you have been dealing with some company in US for the purpose of procuring some software. When the invoice comes, you find that the invoice have come from Hong Kong or Singapore, and you make payment to a company which is in Hong Kong or Singapore. Now, these type of arrangements can be probably affected by way of a GAR, and they can say that, no, we would consider residence to be in some other country from where it is. And the entire corporate veil can be lifted. They can ignore those corporate veils and peers and go beyond that, and it can consider that actually the shareholders are important. So a very wide powers which are given in respect of these aspects. However, they have provided under the circular, there is a circular wherein the GAR provisions have been excluded, where the total tax benefit in India which is obtained is less than 3 crores of rupees. The GAR provisions would not apply. So smaller end SSEs would not be affected by these SSEs. The FIIs which are not claiming any benefit of the double tax avoidance agreement would also be excluded from that. In case if the double tax avoidance agreement, like say for example, we have significant provisions in Indo-Mauritius Treaty, say for example for an anti-abuse provisions, or Indo-US Treaty where anti-abuse provisions are already there, where limitation of benefits have been significantly provided. If there are these significant provisions, in that case GAR provisions would not apply. It is the treaty provisions which would apply. Similarly, in case if this arrangement is already approved by authority for advance ruling, the provisions would not apply. If there is a court ruling which is already obtained in respect of an arrangement, wherein they have, after going into the impact of these decisions, have approved such things, that also would not apply. Merely because you have located your entity in a tax-efficient jurisdiction. And there was so many times we have got some questions which come up. I decided to set up, say for example, a trading entity which is situated in X country. And they said, why did you set up in X country? Because there is zero tax, you have set up in X country. You should have set up in Y country because it is better for you. I said, it's not your change. And that's exactly what the circular says. It is my decision where to set up my entity so long as it's a genuine entity. Merely because I have set up, say for example, in UAE, or merely because I have set up in a country which is Hong Kong, they cannot say that, no, you should have set up in Singapore. Or you should have set up in this country because it is beneficial. You should have set up in South Africa because it is better, it is nearer to Africa. That's not their botheration. It is my choice where I want to set up, so long as there is a commercial substance in respect of that. So they are very clearly provided for that. And once an arrangement is considered to be permissible in a year, the permissible would also, it would be considered to be every year the test would not be applicable, and every assessing officer would not have a right to retest the situation from year to year basis. So that's what is the clarification which has been given. There is a grandfathering which is done in respect of all investments which are made in shares or securities prior to 1st of April 2017. However, it does not give a protection in respect of lease transactions or loan transactions which are done prior to 1st of April 2017. Only investments into shares and securities or other investments which are made prior to 1st of April 2017 are grandfathered, meaning that they would not be covered by the provisions of the GAR provisions. So they have said very clearly GAR and SAR can coexist. So even if there is a SAR, if it does not adequately cover the GAR, so there are specific anti-abuse and general anti-abuse provisions, they can coexist. In case where the DTAA claiming a deduction of DT, see we have an option under Income Tax Act whether to claim benefit of DTAA or the Income Tax Act. See, in 1 year, if I claim DTAA benefit, in the subsequent year, it is more beneficial to take the income tax benefit. They cannot come up and say that, oh, last year you took DTAA because it was beneficial. Next year you are now taking income tax because it is more beneficial. That right, the GAR does not have. GAR cannot prohibit you from doing it. It is your fundamental right. It is right given under the Act, and you are entitled to exercise those rights. So there are no corresponding adjustments which are available to the SSE. So for example, in case if there is a recharacterization of a loan to equity and therefore the money is considered to be interest, the person who is receiving cannot say that, look, they have characterized a dividend, so tax me also like a dividend. They said that no. It's an anti-abuse provision, so if an adjustment is made to you, it is only your adjustment. The other person would have its own fate in respect of the way in which it is done. So no corresponding adjustment would be available to the other person. The safeguards are done that SSE shall have an opportunity of, so there are 3 levels of safeguards which are provided. First, the AO, before making a reference to the principal commissioner, will have to look at those provisions, give an opportunity of being heard. He will have to record his reasons and then make a reference to the principal commissioner. Thereafter, the principal commissioner would exercise his judgment. He will give an opportunity of being heard, and only after he is satisfied that the GAR provisions are applicable, he will then make a reference to a panel or an approving panel consisting of 3 persons. And that would include a person who is an IRS who is capable of being appointed as the principal commissioner, or a member of the board, a retired high court judge, or an eminent person, an eminent person. That a panel of 3 persons would be done. These persons also would hold a meeting, give an opportunity of being heard, and after they are satisfied, they will give a decision. The decision of an approving panel is binding on the tax department, but the SSE can make an appeal after the order is passed before the Income Tax Appellate Tribunal in respect of these the observations of these aspects. So enough safeguards are done. I think the fear which is exercised by the industry in respect of this is not well unfounded. Though similar provisions are there are all across the world. It's not that India is the only country which has got this. Most of the DTAA also has got the similar provisions in respect of anti-abuse. But in India, unfortunately, the way in which the tax is being administered, the way in which the tax officials perform their functions, I think that there is a doubt which is expressed. I think they need to be extremely careful about the way in which the approving panel is selected, the way in which the approving panel is authorized, the way in which approving panel is monitored in respect of performance of this function would actually decide about how the GAR provisions are actually going to adversely or not adversely affect the people. These are very scarcely used provisions, and it should be scarcely used, and it should not happen that every case where there is a more than 3 crores of tax saving, they invoke GAR provisions and take you through these entire provisions. I wish, and I'm sure that this government must take that into account for the purpose of having the entire mechanism. We had dispute resolution panel which has been set up. It is completely a farce. And let me honestly tell you, it's a complete farce. I have no hesitation in publicly telling. I have gone to the board and said that it's a farce. Please remove that. No purpose. In disputes are only increased and no disputes are getting resolved by way of a dispute resolution panel. If approving panel also becomes a panel which just approves and not probably evaluates, I think it is going to become a very great difficulty in respect of action which is taken. I hope that this provision is actually taken in the interest of the nation, in the interest of the industry, and only the actual defaulters are affected. I hope that that is what would be the good thing which would happen. Changes which are done, major change in case of the capital gains. no capital gains for all appreciations which take place till 1st of April 2001. In case of old assets which are held prior to 2001, the market value of those assets on to 1st of April 2001 would be considered a redeemed cost of acquisition and approval. This would affect, all those persons who have acquired assets prior to 2001, they would benefit, or those who have acquired assets prior to 1481, so long as their appreciation between 81 and 2001 is more than 4.26 times, they are all going to benefit. Otherwise, they are going to be neutral in respect of other aspects. Holding period in case of an immovable property has been reduced from 3 years to 2 years for being considered as a long-term capital asset. As you are aware, in case if it's a long-term capital asset, not only that the rate of tax goes down from 30% to 20%, but you also get other revenues for the purpose of making these investments in other eligible investments for the purpose of making the capital asset, the capital gain is tax-free. This benefit would be available once you hold this asset for a period of 2 years. The tax-neutral conversion of preference shares. When the preference shares are converted into equity, there was a confusion whether it amounts to a transfer. In case if it amounts to a transfer, whether it would be considered to be a capital gain transaction. They have provided that it would not be chargeable to tax. The date of acquisition would be the date on which the original shares were acquired, and the cost of acquisition would also be the cost of acquisition of the original preference shares. An important amendment which has been made, and that is an anti-abuse provision, nothing to be alarmed about so much, but it can have some impact. It says that as you are all aware, the long-term capital gain on the listed equity shares are tax-free, provided the sale takes place on the floor of the house and the security transaction tax is paid. There was no condition earlier that the shares should have been acquired by making payment of the security transaction tax. So therefore, if I have acquired shares by way of an off-market transaction where there is no STT which is paid, and when I sell the shares in a transaction which is an STT paid transaction, now it would not enjoy the exemption which is available under the long-term capital gain. This, in fact, the notes, memorandum explaining the provisions of finance bill very clearly provides it does not affect the transactions on which the security transaction tax would not in any case would have been payable, like an IPO related transaction, like bonus issue, like rights issue, etc. This would not be applicable to such type of cases. But where if the transaction had it been done, it could have been done on the stock market, but the person voluntarily decided to do an off-market transaction to take advantage. Like, say, for example, I purchase the shares, but I purchase off-market. I don't pay STT at the time when I purchase. But when I sell the shares, I sell it on the stock market. In such type of situation, they have said that it would be chargeable to long-term capital gains. It would not enjoy the exemption which is available. A very important amendment, and that applies to all acquisition of shares which are made after 1st of October 2004. That is the date on which the security transaction tax was made applicable. Capital gains, deemed capital gains on the fair market value, this is a very, very wrong provision. I don't see sometimes, in over-enthusiasm, they make an amendment, and this is one such case. There is a new section 50CA has been inserted to say that whenever a person acquires a share, and I'm sure that some of the persons would know the reason why this has been made. If a person acquires the shares of a listed entity or an unquoted share, in case of an unquoted share, shares are acquired, and if the cost of acquisition of these shares or the sale price is less than the fair market value of these shares, in that situation, the capital gain would be chargeable to the transferor on the fair market value of these shares. This is a deemed capital gain taxation, which was never there earlier. There is no explanation as to why it is being introduced. But let's take a situation that there is a share I hold of an unquoted company, which is having a fair value of 1,000 rupees. I decided to sell these shares at 100 rupees. Under the existing provisions, I was required to pay tax on 100 rupees by reducing from there my cost of acquisition. There was no requirement for making sale at the fair market value. Now this 1,000 rupees, which is what they are saying about, earlier the provision was that in case where a person purchased these shares, he was required to purchase it only at the book value of these shares. In case if the shares are not purchased at book value, in such a situation, the purchaser was required to pay tax as a deemed gift of the difference between the cost of acquisition and the book value. Now this was the provision. Now it says also on account of sale, There are no corresponding changes which are made in respect of this. I personally feel there is no exemption which is given even for a transfer between the two relatives, or transfer at the time of a marriage, or transfer on the date of death, on account of death, etc. It considers all these transactions. It's a too simple a provision which is to be made. I am personally of the view that this amendment also would have a significant change. We have already made a representation in respect of this change. Joint development agreement. I think the real estate players would have a significant advantage on account of this change which has been made. There was a complete doubt about how the joint development agreements are taxed. And what is the joint development agreement? Joint development agreement, those who are not dealing with that's where a person sells his land or a building, and in exchange he not only gets possibly a cash as a consideration, but he also gets a portion of the constructed portion. To give you an illustration, that I've got a 1 lakh square feet of land on which 2 lakh square feet of construction can take place. I enter an agreement with a developer saying that, okay, you use this land, and out of this on which you consider construct the apartment, of which out of 2 lakh that you consider, 80,000 square feet you should give it to me. Now that was an agreement which was done. There were different views which were expressed as to when does the capital gain on the person who holds the land would get chargeable to tax. The provision now says that in such a situation, capital gains on the transfer of the land would be chargeable to tax only on the date on which the completion of the project is received. So for example, if I enter into an agreement today and that developer constructs a building, and on building, after constructing the building, if he obtains the completion certificate 4 years down the line, then I am required to pay capital gains 4 years down the line. That's a very good amendment. There was also a doubt, when I get 40% of constructed portion, 80,000, how do I value that 80,000? Whether 80,000 should be valued on the basis of the cost of construction, whether it should be done on the basis of fair market value, or whether it should be done on a different basis. The Act now very clearly provides that the stamp duty value of the portion which is allotted to me would be considered to be full value of consideration, plus in case if I have received some cash consideration, that will be added to that, and that would be considered to be a long-term capital cost of sale price. And from that, if I reduce my cost of acquisition, that would be the capital gains would be chargeable to tax. A very good provision. It would give a lot of fillip, because at present, because of the scarcity of funds in the real estate business, most of the agreements which are taking place in case of a joint development agreement, wherein the real estate players do not have to make investments into the real estate. Very good provision, and it would have a clarity in respect of this. There is certainly going to be a significant deferment of tax liability. There is also a provision in case where, say, for example, my right to receive those 80,000 square feet, if I sell it prior to the sale, in that situation, whatever price where I sell my right to receive 80,000, that would be considered to be a sale price, and I will be liable to pay tax at that point in time. For the purpose of Amravati, which is the new capital which is being constructed for Andhra Pradesh, there is a new arrangement which is done, which we call it as a land pooling arrangement. And in case of a land pooling arrangement, in case if the lands are transferred and to the government for the purpose of Amravati, and in exchange they are given the land holding certificate which they can encash and get another alternate land in other areas of Andhra Pradesh. When these type of things are there is a capital gains exemption which is provided for a period of 2 years in case if those land certificates are sold, or in case if the land which is allotted in pursuance thereof, if it is sold within a period of 2 years from the date of handing over the possession, that would be available to that. In case if the land is sold after a period of 2 years, in that case, market value of that land which was acquired is 2 years from the end of the year in which the land was handed over. That would be considered to be the fair value. So complete exemption which has been provided for a period of 2 years in respect of the Andhra Pradesh. I am sure that none of us would have generally land in Andhra Pradesh, but in case if you have, and in case if it goes in Amravati, I think it would be beneficial to us. A technical amendment which has been made with respect to Indian company transferring shares in the case of a demerger of a foreign company, I think it's not going to be very relevant. 54 EC, we had only very limited securities which are available where we can make investments of up to rupees 50 lakhs of rupees in a financial year for the purpose of getting exemption from the capital, long-term capital gains. Now that 50 lakh limit remains 50 lakhs, but there are other alternatives which are available other than those 4 companies or 3 companies which are defined. So you will have newer bonds which would be coming up under section 54 EC for the purpose of making these investments. In case of personal taxation, I will skip very quickly in respect of this because I am sure that by all the newspapers you would have come to know that these are the changes which are made. in respect of that. There is a very strong justification for not increasing the exemption limit from 2.5 lakhs. So a change which has been made, there is a change which has been made which is about 10% increase of the surcharge for the income in excess of 50 lakhs to 1 crore. There was no surcharge earlier. Surcharge used to kick in after 1 year, 1 crore of rupees. Now there is a surcharge which kicks in also between 50 lakhs to 1 crore. There is approximately about 2,20,000 additional liability which would happen. In case of income from house property, there is the rental income which you receive in case if there is a borrowing and in case if there is an interest which is charged as an expense. And the loss which arises earlier, there was no limit in respect of claim of set-off of such losses. Now there is a cap of rupees 2 lakhs, which is applicable to self-occupied house property, is applicable even for rented property or deemed rented property. So now, in case if the loss in respect of rented property is in excess of 2 lakhs of rupees, would not be allowed as a set-off against any other income. It will have to be carried forward, and after it is carried forward, it can be set off only against the income from house property. So that's an important change which has happened in respect of those persons who are doing a large-scale projects for the purpose of giving it on rent. This can affect their right to claim the deduction in respect of other heads of income. There is a limit in respect of maintenance of books of accounts of individuals in HUF from 1.2 lakhs of income or to 1.5 lakhs, and in respect of turnover to more than 25 lakhs, which used to be about 10 lakhs of rupees earlier. There is a presumptive taxation for the purpose of giving fillip to the digital transactions. There is a technical amendment which is made, which was already meant earlier. I'm not going into that. No tax audit to be done where the turnover is less than 2 crores of rupees, provided such person follows the income limit under the presumptive tax. Just to come to the second amendment, which is for the purpose of digital economy, they have said that in case where a person falls within the presumptive tax, which is he has got an income of around less than 2 crores of rupees, receipts of less than 2 crores, he has an option to offer income on the basis of presumptive income of 8%. So he considers in case if his turnover is 1.5 crores, he says his total income is 12 lakhs of rupees and pays tax, no books of accounts maintained, no queries, no questions, and he pays tax on 12 lakhs of rupees and forgets about it. So that's a presumptive tax scheme. To provide a concession, they have said that in case if out of this 1.5 crores, say for example 1 crore is received by way of a non-cash transaction, that is either by way of a check or by way of an electronic or a digital payment, then on 1 crore instead of 8% of presumptive income, it would be considered as 6%. So on that 1 crore, it would be only 6 lakhs instead of 8 lakhs. And on the balance 50 lakhs, which is by way of a cash, it would be 8% which would be presumed, and that is how there would be a reduction. And most important thing is this amendment is effective including for financial year 16-17. So even for financial year 16-17, in case where someone has done a turnover which is by way of a non-cash transaction, he would be entitled to get deduction. He would have a significantly lower. So let's take a situation that the entire 2 crores of rupees of cash transaction, there would be an income of around 16 lakhs of rupees. Whereas in case the entire 2 crores is done by way of a check, that income would be only probably 12 lakhs of rupees, 6 lakhs of benefit, 6 lakhs of income that would fall under 30% tax slab. There could be a benefit of around 2 lakhs of rupees to that person. A very good advantage, and probably the entire cost in respect of doing the transaction digitally would be completely met by way of a tax advantage that a person gets. A very good provision in respect of these aspects. I'm sure that whenever I go to a shop and tell them, I say that you are going to get benefit of probably some tax advantage on account of that. Some of them do agree on that. So partial withdrawal, so for example, from a new pension scheme, if there is a withdrawal of 25% up to 25% of the contribution, in such a situation that would be tax-free. In case of contribution to national pensions, a new pension scheme, earlier the limit was 10% of the gross total income which was allowed to be contributed. Now it is done and it is allowed to be contributed up to a figure of 20%. There was the Rajiv Gandhi Equity Saving Scheme. This has been now, there is a sunset clause. Let me assure you that it is not phased out because it was Rajiv Gandhi, but it was phased out because it was unpopular. And not that equity scheme was unpopular, and that is the reason why it has been discontinued. But at the same time, in case if someone has made investments prior to 31st of March 2017, he will be allowed to continue to make investments, and that would enjoy the deduction which is available. Again, cash donations below 2,000 rupees, about 2,000 rupees in cash to a political or to any person would not enjoy exemption under Section 80G. There is no restriction on the trust to receive this money, but in case if you give a donation and if you take the receipt in respect of 80G, you will not be entitled to claim deduction if it is more than 2,000 rupees. Other amendments, 10% tax on the dividend from the domestic companies. In fact, I have written that, that there is a major problem which is happening. There is a triple taxation, as we call it. There is a corporate pay tax at the rate of 30% plus. When the dividend is distributed, they pay approximately 20% when the dividend distribution tax happens. And when the recipient receives it, he still pays about 10% plus tax on that. So there is a triple taxation in respect of dividend which is distributed by a corporate entity. Unfortunately, that has not been removed. There was just to ensure that the trust and the private, there was a view which was expressed there where the dividend was received by an entity which is a discretionary trust, whether it would be considered to be an amount which is received by an individual or an HUF or a firm, because it would be considered to be an AOP. An AOP was not included, the person who would be chargeable to this 10% tax. It was opined by in some circles that this would not be chargeable to tax. And therefore, a lot of persons had converted their equity holdings into, transferred it to a discretionary trust which was done for their family. The amendment which has been made for the purpose of ensuring that that amount is chargeable to tax, even in the hands of an AOP or a BOI. So that applicability is going on. I personally feel no justification. I think this, I would consider to be the way in which the papers have expressed, this is a Robin Hood provision. I think there is no need for making such taxes it makes the distribution of dividend extremely costly. And therefore, I think there is a need for having a rethink on that. There is a complete prohibition which is for the purpose of making payment in excess of or receiving any payment in excess of rupees 3 lakhs in cash. Now that applies to any amount of receiving from a person in a day one. So in case if you go for purchasing jewelry, in a day if you purchase jewelry in excess of 3 lakhs, the jeweler would be punished, and that punishment would be equal to the amount which is received. So if you purchase 3,05,000 rupees, this would also be applicable to the doctors, this would also be applicable to the lawyers, this would be also applicable, say for example, if a doctor or a hospital, if they receive the money in cash from a patient, in that situation, the doctor or the hospital also would be liable to a penalty of 3 lakhs of whatever is the amount which they have received as the penalty under this aspect. And let me mention that so far as the real estate players are concerned, that limit was already there in Section 269 SS, and that limit continues. And that limit is far less than 3 lakhs of rupees. It is this applicable only to those which are not covered by Section 269 SS of the Act. It is in respect of any person in a single day, any person in respect of a single transaction. So what happens that in case if there is a purchase of jewelry, bill is of 5 lakhs of rupees, if that person comes on 3 days and pays 2 lakhs and 1 lakh, still that person would be covered because it's a single transaction of sale, and that would be covered by this aspect. Similarly, a single operation, if the invoice is more than 3 lakhs of rupees, the amount cannot be accepted in cash. Or a single event or an occasion. So for example, there is an event of marriage which is happening. If a Faraz Khana fellow supplies the Faraz Khana and then he raises an invoice, 5 invoices, but for a single event of a marriage, he cannot receive the money from that event of more than 3 lakhs of rupees. This is a restriction in respect of receipt and not in respect of payment. So this would penalty would be equivalent to the amount which is received. In case of an individual or an HUF which pays the rent in excess of rupees 50,000 would be chargeable to a TDS by individuals. The rate of TDS is 5%, and that would be chargeable to tax. There is a mandatory fees which is payable in respect of delay in filing of return. Now, in case if 31st of July is the date on which the returns are required to be filed by certain SSCs, if you miss that date and if you file it on 1st August, the software would not permit you, if that's what is our view, it would not permit you to upload the return or file electronically unless you actually deposit 5,000 rupees. As in case if your income is more than 5 lakhs of rupees, it is 5,000 rupees of penalty if the return is filed between before 31st of December, and in case if it is filed after 31st of December, if pay a fees of 10,000 rupees. In case if your income is less than 5 lakhs of rupees, even where your income is less than taxable, even where you have a nil income, but you are liable to file return of income, like partnership firm, like private limited company. In that case, the minimum penalty is 1,000 rupees. And that would be applicable irrespective. There is no penalty, there is a fees which is payable. It's like late filing fees in respect of the Companies Act. There is a withholding tax provision under 143(1) for the purpose of assessment. I think this is again come back. I think it was very well appreciated when this provision was taken away. They have now provided that in case if the assessment proceedings are going on, the AO may write for the purpose of withholding of those return refunds. There is a penalty which is provided of 10,000 rupees on CAs, merchant bankers, registered valuers, in case if there is a incorrect valuation report is done. There are two things, I have two comments to make in this. First, that it is completely unwarranted. And second, I wish to assure the government that those who are wrongdoers who are not going to get deterred by 10,000 rupees. So honestly speaking, this is a useless provision. I think we are not afraid of that provision. But the question is that if they are thinking that because of the 10,000 rupees, those persons who do wrong are not going to do wrong, it is completely unfounded. If they really want to make a provision in respect of penalty, provide a very deterrent penalty, which would definitely have an impact on that, and provide mechanism for the purpose of ensuring that you only catch those persons. I am, for one, is in support. In fact, KCM would completely support any wrongdoers being penalized, be it professional or be it any organization. I think we are also subject to the same amount of scrutiny which my businessmen or my SSEs are likely to do that. I am not afraid of this provision. But 10,000 rupees is completely a mockery. I think this is what is required to be done. I have never said that this type of penalty, I am not an advocate of saying that this penalty should be withdrawn. I think we can face that, and I think we need to be tightening our belt for the purpose of ensuring that we do not commit mistakes. Survey the places of charitable. I think charitable trusts have been very, very largely misused by people, and therefore now they have provided that even case of NGOs can be searched. Earlier, the provision of search applied only at places where the business was carried out, but now where the businesses are not carried out, but even the charitable activities are carried out, like if you call it as a charitable activity, some hospitals, some educational institutions, these are also can be searched, even they are managed under a trust, which is enjoying the exemption. Centralized issuance of notice pursuant to this modification or post demonetization, they have set up centralized cells for the purpose of investigating cases and issuance of notice without the jurisdiction being there with an X person. To enable that, a 133C has been introduced, because now they are working on big data as a theory, and therefore they will assimilate that information at one place, cross-check, and send notices on a centralized basis. People have already started receiving notice in respect of deposits which are made in the bank account, an exercise which have already been started. Time limit for assessments have been revised. Over a period of 2 years, assessment would be completed within a period of 12 months from the end of the assessment year. Very good provision. I think that's a very fundamental way. Only issue which would happen is that the first time barring date would happen on the next September, which would coincide with the dates for compliance in respect of tax audit cases, which is going to become a burdensome. And a year after that, the assessing officer would get only 6 months for the purpose of completion of assessment, which is also going to be a real burden on the assessing officers. Let's see how do they meet with those challenges in respect of that. So an interesting provision which has been made, that in case where a person is searched, in such a situation, the earlier provisions provided that assessments for only 6 years can be reopened, 6 assessment years can be reopened. Now they have provided that even for a further period of 4 years, beyond that 6 years can be reopened, provided the assessing officer detects some assets which show income pertaining to those 4 years in excess of rupees 50 lakhs, which is detected. So in not small cases, the 5 lakhs, 10 lakhs, 15 lakhs is there, they cannot do it. It has to be a concrete evidence in respect of income pertaining to those years, and the value of that income would be more than 50 lakhs of rupees in aggregate. In that situation, they can even reopen period up to 10 assessment years prior to that. It is important that it is applicable only in respect of searches which are conducted after 1st of April 2017. It does not apply to any other case. And same provision would apply to also a connected person and not only the person who is searched. I'm not going into the aspects of search and seizure. In case if you have any questions in respect of that, let me have your views in respect thereof. already expired 2 hours of this. There was a very funny provision of 197C, which was introduced in the Finance Act 2016 last year, which was neither applicable nor it would have only gone against the department, and therefore they have withdrawn that provision. We had also made a presentation in respect of that. There is a provision which is completely inapplicable, which says that in case where there is an income of an earlier year which is detected and not declared as a part of an IDS, there is income disclosure scheme. In the year in which the notice is issued, the income becomes taxable in that year. In fact, the year in which the notice is issued, it can never be taxed in that year, because you issue the notice only after the expiry of that year. If it becomes taxable in that year, it cannot be taxed under that notice. It's a completely no-go in respect of that, and it was intended to frighten people that I can even reopen assessments, or I can even tax you in respect of 20 years down the line. I can tax you even for an asset which is detected 25 years down the line. I think that has been fortunately withdrawn, and therefore this would happen. A very good amendment which has been made in section in case of political parties, which says that in case if the political parties do not file the return of income on or before the due date of filing returns, in that situation they will lose the exemption which is granted to them. They will have to pay tax in respect of these aspects. There is no exemption which would be available to the political parties in case if they receive the donation in excess of rupees 2,000, otherwise than by way of a crossed account pay check, or by way of an electronic clearing system, or by way of an electoral bond. It is a very interesting provision, and I think that's where the intention of the government looks very clear as to they really want to ensure that the political funding becomes transparent. Now, electoral funding, the way in which I don't know how many of you have actually gone into the mechanism of that, what it says that I can purchase as many of electoral bonds as I want. These are like bearer bonds. So I go, and these bonds can be only purchased by way of a crossed account paid check. So I have to only use accounted money for purchasing these bonds. Once I purchase the bonds, let's take a situation that I purchase bonds worth 1 crore of rupees. These bonds can be only encashable by a political party. It cannot be encashed by any person other than a political party. So I have to give out of this, or it can be credited back into the same bank account from where it has been purchased. So for example, I have purchased 1 crore, out of which I decide that I want to give 30 lakhs to BJP. So I give it to BJP. BJP deposits that money, and it does not have to disclose where did they get this money. This actually, the only ground on which the political parties were stating that we don't want to file the list of donors because they would be otherwise vengeance against them. This has been view has been taken away. Now they will have to say that this is the money which I have received by way of an electoral bond. This is the money which I have received from these parties, and this is the money which I have received for less than 2,000 rupees. This is important. I think all the corporates must make use of it. They need not now worry. Now they have purchased 1 crore of rupees. They can give money whichever party that they want without fear, because their name would never be disclosed. Once they have purchased, it's like a purchasing gift card which can be only encashed by certain persons. So you have purchased the electoral bonds and give it to a political party, and that's it. So you get the deduction in case if you have purchased. There is no disclosure which is made. You don't have to tell to the income tax officer also that whom you have given. I should have given wherever I wanted. There is no need to give that information. So it's a very important thing, because since they are non-encashable by any person other than a political party, it becomes an instrument which can be only used for the purpose of giving election funding. Extremely good provision, and I think we should make a use of it. No exemption in case a change of object is not intimated within 30 days. There are trusts which are formed thereafter the change in the terms and conditions which are made. In case if it is not intimated within a period of 30 days, in that case those trusts would remove